see the sun, I'm rising up, I feel the love now, oh, it's in my vision. You know I ran around, and I got lost, but now I found you, well, I can't shake this feeling. Oh, it's gonna take me a little while, just to get my head around this moment. But I can see the sun, I'm rising up, I feel the love now, oh, it's in my vision. And it's telling me run, 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 don't give up. And it's telling me run, 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 and don't give up.
Welcome to the Retirement Learning Lab, where we teach you how to retire without running out of money. My name is Van Richards, and this is the daily NASDAQ stock update. Thanks for joining me today. We have a lot of really good information to talk to you about. The markets were down just a little bit today, a little bit less than 0.5%, but hold on to yourself for tomorrow because there could be some things coming that will make the market pretty turbulent from the standpoint. If we look at what might come from tonight's debate with the president, that could have some sort of an effect on the markets tomorrow. But I think that really one of the biggest things that's going to make the markets more turbulent tomorrow is Disney came out after the markets were closed today and announced that they're going to be laying off 28,000 people in Florida and California. That's going to hit those economies pretty hard. It's also going to give more incentive to Congress to get their act together to do something to help with stimulus, because without it, we're going to have more businesses that are going to be like Disney that just can't support the employee base that they have. We're also going to have that 28,000 that's going to go on to the unemployment roll for the following week. So we'll see how things work out tomorrow. Hopefully I'm wrong. We'll just have to see how it works. But we have two really good stocks to talk to you about today. One of them is a name that you all know, and that's PepsiCo. Everybody's familiar with Pepsi. We also have PayPal, which, 5 years ago, PayPal wasn't really that familiar. In 2015, they spun off from eBay and created its own company. And they've really come to the forefront. You're going to see that they have had astounding growth over the past 5 years. It's just been amazing. If you had a DeLorean and you could go back and, the one from Back to the Future, you could go back and you could buy stock in PayPal or buy options, gee whiz, you would be a wealthy, wealthy person. But we're going to talk about that just a little bit more today. Let me make the screen just a little bit bigger for you so that we can get right into talking about these two different stocks today. I know that you know Pepsi, but maybe do you not know PepsiCo? Because it's more than just the sodas. Here, watch this. 191 billion in market capitalization. That's a big, big company. If you think about it, you would think that Pepsi probably had a better year than it did because the coronavirus, everybody's staying at home. They want to have their Pepsi. They want to have their Doritos. They want to have their Lay's potato chips. That wasn't really the case. But when we see what happened over the past year, hold on though, we're going to look at the last 5 years because there's more to this story than just what happened in the past 12 months. A year ago, it was at 133.23 and it ended today at 137.16. That's an unimpressive 2.95%. But hey, it was the coronavirus pandemic that went on around. If you follow the dancing cursor, there it is right there. Okay, but let's look at it just a little bit further back from that standpoint. Let's go back 5 years and look at this company. 5 years ago, it was 81.28. Now let's add up and see what happened. 137.16. When we look at the total rate of return at 68.75, and that's really not too bad. Let's look at the APR, the average percentage, the APR, the annual percentage rate is 11.03. Listen, I have to repeat this again and again. I'm sorry, but to sound like a broken record, but the past performance is not going to be any type of guarantee of the future results. But we want to look at what's happened in the past to get an idea of what's happening, might happen in the future. Let's take a look at earnings the way that we do on a regular basis here. If you look back at earnings over the past, let's say from 2014, the solid line is going to be actually what was paid, and you're going to see the estimated earnings are the dotted line. And you're going to see that most of the time, Pepsi actually was over top of what the estimates were for every single quarter, even during the pandemic in itself. So they've done pretty good from that standpoint. Another really good thing. Hey, this is the best thing about Pepsi. Hold on a minute. Listen to this.
The beauty of your side.
One of the most beautiful things about Pepsi is it pays a dividend of 2.96%. And if you go back and you look at this company quarter by quarter, you're going to see that over the past 5 years that they have steadily increased their dividends. Now, we all know that they're a stock, so the past can't be a guarantee of what's going to happen in the future. But this company has a pretty good record of paying dividends on time. So I think if you're looking for a dividend paying stock, and I'll remind you real quick here, the idea is that if you're a retiree and you're looking for better income, look at quality stocks. You know, you can't guarantee that it's going to happen, that it's going to continue, but look at the dividends. Create a portfolio. If you look at the NASDAQ 100, there's about 60 stocks there that have dividends, and they're pretty consistent. Hey, there's a couple of them there. Be careful, especially of the foreign companies, because in producing dividends, it gets a little bit sticky from that standpoint. But this company's actually done pretty well from the standpoint of dividends. When we compare it to other companies, that are similar to it, it's about the same. Yeah, they have had better performance than some. They've had worse than others. If you look at them compared to Coke, hey, personally, I like Coke better than Pepsi. But when we look at the actual performance of the company, Pepsi in the past year has actually done better than Coke. We compare it to General Mills. And remember, why are we comparing what we think might be a soda company to General Mills? Because General Mills is really not a soda company. The reason is because of the Frito-Lay that's there. You're going to be astounded in a few minutes when you see how Quaker and Frito-Lay has contributed to the profitability of Pepsi. You also have to look at the competitiveness of Keurig Dr. Pepper. You know, I didn't even know for the longest time that Keurig and Dr. Pepper had merged, but they have. I use Keurig every single day. And remember, the past performance can't be a guarantee of future results. You know, the moat in itself, remember what a moat is? A moat is going to be that imaginary barrier between the company and their competition. That imaginary barrier between this company and Dr. Pepper and Coca-Cola and General Mills is going to be brand recognition. Everybody knows Pepsi, Mountain Dew, Gatorade. Hey, if you are a Pepsi fan, which would you rather have, Pepsi or RC? Let me know that in the comments, because I really like to know. I kind of like RC, but you know, it just depends. Ricardo, you're asking, will it beat the estimates for this quarter? I don't really know the answer to that. If we look at what its projections are, it's probably going to beat them, but we can't guarantee that. But I would say they're on a pretty good track from that standpoint, because the products are being sold, stores are open back up, the product lines are still going. So yeah, I would count on that they're probably going to at least make the estimates for the quarter in itself. Now, here's a real interesting thing as we go into this a little bit further. I want you to look at this. They have efficient distribution, which means that when they go and they start delivering Pepsi, Mountain Dew, and Gatorade, hey, they're also be able to deliver Frito-Lay and Quaker. So they have an efficient distribution system. And you might not know this, but Coca-Cola doesn't own all of its distribution centers. That's really kind of interesting to me because, actually Coca-Cola has an agreement with Monster Drinks to produce them. So some of their own production is not done in their own facilities that they own. But that's pretty common in the food industry from that standpoint. They have a production advantage. This is actually Pepsi has a production advantage because they're so large. They're so large that they're able to distribute it. Now look at this. Look. 65%, about 65% of the profits are actually coming from Frito-Lay and Quaker. They're not coming from the soda business. They're coming from the snack foods. Hey, those salty and sweet snack foods, that's what's paying the bills right now. When we look at what the current price is and we compare it what the fair market value is, now the fair market value is what, this is what Morningstar is saying is going to be the fair market value. And if you followed me before, you know that let me explain it real quick. The fair market value for a company like PepsiCo is done by a multiple of the earnings per share. That means that they're going to take, let's say, the earnings per share times maybe 15 or 10 or something like that. And that's going to be how they're going to get that fair market value. It's not something they just pull out of a hat. And when we look at the current price compared to the fair market value, if I can get it out, they're a little bit discounted right now. So this would be considered really a 3-star fund. I have my own word for a 3-star fund, and that's called GARP. Well, it's not my own. I stole it from somebody else. But GARP is growth at a reasonable price. And that's what I think that this stock is. It's growth at a reasonable price. When we look at what other analysts are saying about PepsiCo, I think that you're going to get a mild reception from this. 7 of the analysts out of 14 are saying it's a strong buy. 5 of them are saying that it's a hold, and 2 of them are saying that that this is actually going to be a hold. So, I mean, truly, when you average it out, this is really comes out to just be a buy. Yep. It comes out to be a moderate buy, not a strong buy. But remember, this is not my recommendation. This is just reporting to you what is possible through the analyst in itself. Let's move on to PayPal. PayPal was up. PepsiCo was down. Actually, PayPal was up 1.29% today. So not too bad in a market that was off just a little bit. And, you too might think that you know PayPal, but there's more to PayPal than you think there might be. Watch this. One of the ways that PayPal has made growth is by acquisitions. They own Zoom, they own Venmo. A lot more people are probably familiar with Venmo here in the United States because there's not as much money that's going internationally. Zoom, XOOM, I'm going to assume that's how you pronounce it, is going to be more for international transfers. Venmo is, hey, you're out to dinner with your friends and you want to split the bill. You basically go back and forth with Venmo. That's the way that company works. There's actually some other companies that they've brought into the fold too. If we go back and we look at this is an astounding stock story. Those of you who listen to this on the replay, you're getting a real treat of understanding how this is going to work. 103.59, my gosh, a year ago, and today it ended at 194.5. That's an astounding 87.76% rate of return. Now, hold on. When we go back and we look at this, remember, hey, past performance, no guarantee future results. But let's go ahead and go back in the Wayback Machine and look at what was going on in 2015. In 2015, this little old stock was $32.83 per share. And remember, it ended $194.50 today. Got any idea? Can you do the quick math in your head? I couldn't, so I had to figure it out. 492.45% in 5 years. That's an APR of 42.73%. You know, somebody had put on Facebook the other day one of these questions: which would you prefer? What kind of car would you rather have? Would you rather have the General Lee? Would you rather have the Knight Rider? Would you rather have the DeLorean from Back to the Future? Who wouldn't want the DeLorean from Back to the Future? Because you could go back to 2015, buy $1 million of this stock, or at least buy the options on it and be a gazillionaire. 42.73%. Look, I have to tell you again, though, there's no guarantee, obviously, that this is going to be a repeat, but there's a lot of analysts that are very bullish on this stock. There's no dividend, but I don't think that's anything to be shied off away from. When we look at what the earnings are, yeah, the coronavirus, I want to make it just a little bit bigger for you so you can see here. This is 2015. But when we go over and we look at the earnings during the coronavirus, yeah, it was down, but the earnings have just gone through the roof. Look, the reason is PayPal is a unique company. It's a customer to merchant company that is unlike any other, and they laid the groundwork long before the coronavirus ever came into play. And when the coronavirus came into play, money got dirty, literally. Nobody wants to be trading dollar bills, and that's one of the reasons why this stock has taken off. And that's actually one of the reasons why that there's a lot of analysts that are actually very bullish on this particular stock. Look what other companies are doing that do the same thing. Global Payments, MasterCard, and Discover. Discover's actually kind of under everything. They're the one that's in gold here. If you look at the dancing cursor on the screen, they haven't really kept up. But when we look at PayPal, PayPal has just gone beyond, because remember, PayPal is more centered on that customer merchant relationship. They're really, there is some credit that can go on with PayPal, but they're not like MasterCard, where they're actually trying to get you to borrow. And I think that maybe MasterCard might take issue with my comments, but they're not trying to get you to keep a balance. They're trying to just basically have it as a payment system. And it's a unique system that is, it's very scalable. Remember, though, the past performance, I know I say it a bunch, but it's not a guarantee of future results. When I say scalable for the future, what I mean is this. You have a company, if they did $7 million worth of business through a system, it's just as easy for them to do 70 million, 700 million, 7 billion. It's very scalable for the future once it's set up. They have a niche that they've created, and they started it when they spun off from eBay. And it's been very, very easy for customers to use. And actually, this is where the network effect plays against a company like PayPal. And what the network effect is, it's like there's more people that are using it, so there's more people that will use it. And the way the network effect works to the negative for PayPal is this is such an easy product to use. It's also an easy product to leave. If there's somebody that has something that's better, that comes up with something that's faster or cheaper, really it's going to be cheaper for merchants, because merchants will end up paying probably the brunt of everything. You may see this company dwindle pretty quickly, depending on if there's something else that comes out that's more profitable than that. When we look at what the analysts are saying, and this is what Morningstar is saying. I use Morningstar a lot because I respect their opinion. It's a great deal. Their fair market value is way under where they are right now. It's $110 compared to $194.50, which is a 76.82% premium. So they're saying that it's overpriced. Remember, the star system for Morningstar, the way that it works is if you have a overpriced stock, they're going to give you fewer stars. If you have an underpriced stock, then they're going to give you a lot of stars. So this stock would have to drop down below $110 for it to get maybe 4 or 5 stars. It'd have to be a pretty big disruption to the way things are working from that standpoint. When we look at what other analysts are saying, there's a lot of people with eyes on this company. There are 32 analysts watching it. 25 of them are saying that this is a very strong buy, 3 or moderate, 3 or hold. There's nobody that's saying to bail on this. And really, to me, that's pretty surprising, considering that it's that Morningstar is saying this is so overpriced. I like the stock, but I'm going to just tell you, I'll go ahead and ring the bell on it and tell you that most analysts are saying that it's going to be a very strong buy. But you got to understand that when you have a stock like this, the PE ratio on it is pretty high. That means the price to earnings ratio. And when we look at it from that standpoint, there's a lot of room for this stock to fall in the event that the market goes down. But you have to also look at what the prospects are for the actual profitability. There's nothing that's standing in the way of this company continuing to move the way that it is. The coronavirus has really changed things a lot. The CEO of Shopify basically said that what the coronavirus has done is it's moved us, light years ahead in business, because we are forced to do e-commerce because there's so many people that are still staying at home. And if they're not staying at home, they prefer to buy through something like Amazon or something that's going to be online. I'm one of them. I am sure that you are too. You'll see that the stores are not quite as crowded as they used to do. I live in Houston. The freeways are not as occupied as they used to be. I took a drive. I had to go down to the medical center today for an appointment, and it took basically about 30 minutes to get there. In February, that same trip would have taken me at least about 45 minutes to an hour. There's a lot less people that are going back into offices. There's more people that are buying online. That's the reason why PayPal is probably going to meet its estimates on its earnings from that standpoint. So with all that said, I'm going to tell you one more thing, and I want to go back over here just a second. Remember, the past performance can't be a guarantee of future results, and I'm not making a recommendation on this because I can't. The only way that you can get a recommendation out of me is if you and I talk about your personal situation. I can't just give a blanket recommendation to people over the internet because I don't know you and you don't know me. But if you'd like me to give you some advice on your particular portfolio, I'll give you 20 minutes of my time, and it'll be absolutely free. All you have to do is go over to my website at richardsfinancialplanning.com, go to the schedule a call to learn more button. If you'll click on that, then you'll find a calendar that'll pop up. The calendar, you can pick out a time that you'd like. Generally, my mornings, my afternoons, I'm doing stuff like this. So the mornings you'll probably find will be the best time to have a time to talk to me just a little bit. We'll either do it on the telephone or else we'll do it by Zoom, your preference. Then we'll basically see if there's anything to go from there. But get a chance to talk and see if there's anything that I can do that'll help you to set up your accounts so that you don't run out of money during retirement, because that's really the focus of what I do here. So with all that said, I want to thank you for joining me today. Hey, listen to the presidential debates tonight and let me know tomorrow what you think. Hopefully the markets are not wild, but hold on to your hat. Anything can happen. Stand by for the disclosure and come back tomorrow. We got lots more stocks to talk about. Have a great evening.